in terms of debt, and then don't let us make any mistake about that. It's very tough at both the federal and state level.
Correct.
So they need to get out of this debt trap one way or the other. If not, you have a very serious problem on their hands moving forward.
Well, in terms of debt financing, we are not seeing a moderation. Truth be told, what you are seeing is a change of strategy. Because if you pay down your local debt, remember that the international window that you're taking is still a borrowing, and it's outstanding. The only difference here is that it's been spread for longer number of years, which also comes with its own risk, as, even though your coupon is locked down, but what about the exchange rate movement? You never can tell of what will happen to the exchange rates within the next 10 years or 30 years, for which those instruments are also outstanding. Yeah. So those are also issues that you're going to be looking at. But the good point here is that the corporate space can now begin to receive some breather, because before now, the corporates and the subnationals, even though most of them are not viable, they've not been able to compete with the federal government, which is the biggest...
States and local government.
Exactly, which is the biggest supplier, or which has been the biggest supplier, still the biggest supplier in the market. Even with this reduction, the federal government will still be the biggest supplier of the market. But the point is that most corporates and, of course, viable subnationals can now begin to access the domestic debt market, because from the fact that the central bank is not doing a reissuance, we've seen a couple of commercial papers, that came into force in 2017, and most corporates are still exploring these windows. But the cost of borrowing has been the challenge for most of them. Now, with the rates crashing to as low as single digits, what this will do for corporates is that you'll see a decent commercial paper being issued at 14%, and this is very fantastic. For most corporates.
I'm going to like that.
Yes, that's what will happen essentially. By the time you see the Treasury bills rate maturing, the OMO rate will follow suit, and the import of that, because that will be the starting point of valuation. If I'm taking up a corporate instrument or a subnational instrument, I'll build in the risk of repayment, and that would take...
And I can put a premium.
It will take a cue, of course.
On the corporate.
You put a premium, and it takes a cue from where the Treasury bills rate or the OMO rate is, which is the risk-free rate, essentially.
Anyway.
Yep.
Yeah, but let's put all this together into the basket of the monetary policy, Godwin Emefiele and the rest of his team, into where we see policy rate, cash reserve ratio, moving forward into 2018. Some folks are saying we could see a CRR or policy rate haircut before March 2018.
Well, what we have anticipated, going by the comments from the central bank governor as at the last MPC meeting.
The MPC communique.
The MPC communique. It's looking like he is guiding towards a possible reduction, in interest rates. But the position has been that whether or not MPR is reduced, we're already seeing, because in the instance that nobody is trading the MPR, except some instruments that are benchmarked to hit, you're already seeing a market rate that is already moderating. Remember, there was a time, sometime last year, when MPR was 12%, and we saw yields in the bonds market trading as low as 11%. So market itself can pitch tend, even though whenever there is a change in MPR, it tends to move, the direction of interest rate. So for interest rate, we are a little cautious of the central bank guiding a direct easing by reducing the MPR, say, from 14% to 12%, because of the development within the global space. That may send a very wrong signal in terms of the high-yield environment that you're already seeing in most emerging markets.
MPC will be meeting in about a month from now. Today is the 13th of December. I'm sure the next MPC will be around the 21st of January. So technically 5 weeks from now.
Correct.
What's your outlook from Afrinvest on whether it's a CRR or liquidity ratio? If you say you don't think the MPR would at least shift, would there be a CRR or LR haircuts?
Well, liquidity ratio will most likely remain at 30%, because even at 30%, banks still deploy their assets, towards liquid instruments, such that when you look at effective liquidity ratio for the banks. Some of them are keeping as high as 50-60% liquidity ratio, depending on their strategy for deploying.
It's good doing business with the central bank.
Correct. It's
keep
good,
money, keep money with the central bank. It's good doing business with the central bank. Keep money with the central bank.
Yeah,
Go home and sleep. You come back and get your 30% plus.
Correct. Yeah, but on CRR, the argument has always been that at 22.5%, the CBN is curtailing the bank from actually doing the real business of banking, which is financial intermediation, lending to the real sector, as people would claim, you know. But we have a banking industry currently that is just coming out of the development in 2016 when the economy slipped into recession, and we saw a lot of non-performing loans, you know, which were from specific sectors, oil and gas, power, general commerce, and the likes. Now, the banks are becoming more cautious. So for us, we are not seeing so much of lending opportunities, you know, in the real economy, such that even if there is a reduction in cash reserve ratio, you are not likely going to see an aggressive deployment into creating aggressive risk assets.
So if you reduce the CRR, the banks may just take that money and put it in their liquidity ratio.
And continue to play within the opportunities available within the fixed income market. Banks will lend, no doubt, but they will identify opportunities that are less risky, even though it's called risk asset, you know. But you don't want to create assets that will become problem for you going into other years.
Because they have enough troubles already.
Thanks
for solving some of the problems
and
the troubles of understanding the current yield environment in Nigeria's fixed income, and explaining President Buhari and his administration's debt strategy. Robert Tomatunde from Afinvest. Let's continue the conversation after the break. We're wrapping up the program in just a few minutes.